The S&P 500 is up more than 16% so far this year, but some of that momentum has fallen off so far in August. That trend continues? Yes or no? I don't know. Let's take a closer look at the technicals with Todd Sohn, the ETF and technical strategist at Strategas Securities, a Baird company. Todd, great to have you with us. I mean, what's happened really since, I would say, mid-July is that we've lost leadership. We've seen Apple and Microsoft, just as an example, down 12% from those highs. So what do you foresee from here?
Yeah, I think it's a great time to zoom out, right? We're 10 months off the lows from back in October. S&P up 26% since then. And yes, the momentum has come out of the larger influential weights. We're nowhere near an oversold condition, I will say that. We're only, 3% off of the highs a week or so ago. So I would stay patient here through a bumpier seasonal time frame. If things get a little more rockier, look towards 4,200 to 4,250 as where you want to start to add more exposure, particularly across the whole market. Now, there are timelier corners, right? If you have too much tech exposure or if you're out of tech tactically, look at energy. Energy hasn't worked for some time. There has been extreme amount of outflows from that space, and I think that's starting to take the leadership baton here as maybe a whiff of a reflation story plays out.
Yeah, I mean, SLB, Schlumberger has seen a nice performance of late. I'm curious, though, I mean, because you also cover ETFs, just in terms of the ownership of large cap tech, it's extreme across ETF styles.
Yeah.
And so I'm wondering how that factors into the potential momentum to the downside that can sort of just happen and build because of mass ownership of the biggest names.
So what's strange to me is that the XLK has seen outflows year to date, but there are other avenues to get large cap growth exposure. I mean, Russell 1000 growth, 40% of the index is Apple, Microsoft, Amazon, et cetera. So could you get a little bit of a avalanche of selling? That's always possible. But I also am reminded that ETFs only impact about 5% of the underlying activity within markets, right? So yes, you could get a little echo chamber of selling, but I think we're in such a different cycle now than last year, right? Last year, it was a terrible year for tech, given the inflation issue. I still think these trends are much stronger now than we've been used to, and so I would still look to add the exposure to those names. If you do not want that Apple, Microsoft heavy exposure, try equally weighted NASDAQ 100 instead, QQEW, or even equal weight tech.
Right.
So that way you're getting a little more spread out among the semiconductors and smaller software names too.
When you said 5% of the underlying market activity, is that by volume?
So if you think about ETFs, there's creation and redemption units, right? The creation units are where you start to actually have to buy the underlying securities. And so I understand ETFs can sometimes be villainized here, vilified. But their underlying impact is really small, especially for some of these large cap names too. There's just not much of an impact.
Okay, so you like energy this year? You like the leadership, the perks that we've seen so far?
An interesting stat from energy at the end of last year is you doubled in weight in the S&P 500 from 2 to 4%. That's very rare historically, right? Even as a small base. And you usually spend the next 6 to 12 months going sideways. And that's exactly what energy has done. Now that you have commodities coming kind of back to life here, and I also like that you've seen outflows of energy ETFs, it's the most timely area in the market right now because tech has already run. And if you're playing it tactically, take a look at those names. They've spent the larger part of this year doing nothing. And so if you just need to put fresh money to work in the equity market, I think that's the place to be.
There's an argument, too, that energy historically has been a much higher percentage of the S&P 500. And so if you assume even that energy recaptures even half of that historical exposure, there is still upside here to close that gap.
Look, over the last 50 years, energy's average weight is about 11% in the S&P.
And what is it? It's 4%?
4 to 5 somewhere right now. So if you're really optimistic on the space and this energy renaissance, then there's way more runway for the names.
What other sectors are looking good right now?
Industrials act great. I think machinery names are pausing, kind of like big tech, but the leadership from industrials is fantastic. I think consistent with this kind of new cyclical bull market. And then conversely, I would avoid the bond proxies, staples and utilities. You have 5% short duration yields. There's just really no reason to own staples and utilities. Yes, they can give you clues about a more defensive posturing, but why am I going to bother taking the equity risk when I can go to a T-bill and get a higher dividend yield than the entire sector? So I would avoid those bond proxies, look to industrials. I think discretionary's got some strong pockets. The home builders have got a great run, but look to the derivatives of the home builders, some of those retail names. They're starting to improve. So there's all sorts of different pockets here outside of tech that are still very much timely in the market.